Welcome once again to our filing for Social Security, the choice of a lifetime webinar brought to you by Connected Wealth Management and our partners at Nationwide. I hope this today finds everyone healthy, their families healthy. If you choose to get your vaccine, you will have gotten your shots or close to getting your second shot, and we will have that return to normalcy that so many of us are looking to get to. As I mentioned, filing for Social Security, the choice of a lifetime, brought to you by Connected Wealth Management and Nationwide. I'm Frank Rayhat. I'm the Vice President of Wealth Management here at Connected, and it's an honor to be able to continue to bring you vital and important webinars like the one that we'll be talking about today. When we think about Social Security is one of the largest retirement accounts effectively that you own. You've been making payments to it over the course of your working life. So you want to make sure that you get the most out of Social Security. And one of the things that I found out over the course of my career and even helping my parents is that there are a lot of choices when it comes to Social Security. There's the when, how much, what to do, how do I do it? And we're going to take time today to answer a majority of those questions. We do have our expert, Doug Ewing, with us today. Doug has over 16 years of industry experience. Doug is a CFP, and Doug was admitted to the Massachusetts bar in 1990. And as mentioned, got his start in the financial industry back in 2003. It is my pleasure to hand the reins over to you, Doug, to go over this very, very important information.
Okay, well, thank you so much, Frank. It's really a pleasure to be with everybody tonight. Again, my name is Doug Ewing. I'm a vice president with the Nationwide Retirement Institute. I cover the Western U.S. from my home here just outside of Denver, Colorado. And tonight we're going to be talking about what is probably our most popular topic, and that is Social Security. So before we get started, let me just give you a little bit of background. As Frank mentioned, yes, I am an attorney, and yes, I am a certified financial planner. As we look at our important disclaimer slide, though, I think it's worth pointing out that while I am an attorney, I'm not your attorney. And what I mean by that is I'm not here this evening to give anybody specific advice about what you should or shouldn't do with respect to Social Security. One of the things we're going to talk about tonight is that when to claim Social Security and the strategies that you implement are going to be based on your own individual circumstances. Very simply, there are no right or wrong answers when it comes to Social Security. Our goal this evening is to present you with enough information so that when the time comes, you can make a really well-informed decision that's going to be the right fit for your individual circumstances. So now that we've got that out of the way, let's take a look at our agenda. So as you were waiting for the call to start, or the webinar to start, you may have noticed the title of the presentation, The Choice of a Lifetime. We're going to talk a little bit about why we call this presentation that. Social Security is kind of a unique benefit in that as soon as you become eligible, you have an important decision to make, and that is when you're going to claim your benefits. So we're going to look at that in a lot of detail. Then what we're going to do is transition and talk about some of the basic features of Social Security that everybody wants to be familiar with, and some of the different rules and benefits that are available. So we're going to talk about spousal benefits. We're going to talk a lot today about survivor benefits. That's a big issue. We'll also look at what happens when people get divorced. That's another very hot topic when we do this presentation. So we're going to cover all of that. And then at the end of the presentation, I'm very excited to be able to share with you a tool that we've put together at Nationwide called our Social Security 360 Analyzer. And this is a tool that will break down the Social Security claiming decision for you and help you make that well-informed decision that we've been talking about. So with that, let's jump right into it. And when we think of that title, The Choice of a Lifetime, this is what we're referring to. So when we look at this slide, what I want to do is direct your attention to the bottom of the slide. And what you will see there is that when it comes to claiming Social Security, there is a very wide window of time in which we can claim our Social Security retirement benefit. We can claim as early as age 62, or we can wait all the way until age 70 to claim. So the question most people have is, well, when does it make sense to claim? And I think kind of a helpful starting point in this analysis, and it's also kind of fun, is let's take a look at what everybody else does. So we pulled some data from the Social Security Administration, and this is a couple of years old, but it's pretty representative. This doesn't change much from year to year. And I want to start by directing your attention right to the middle of the slide. And what we see here is that most people, and when I say most, I'm talking barely most, 33% of people will claim Social Security at their full retirement age. And this is important because full retirement age is the age at which we are entitled to our full Social Security benefit. So that's what most people do. But look at the second most common age at which people claim Social Security. 62 years old. 31% of people will claim Social Security in the very first year that they become eligible. Now, the reality is that there are some good reasons why sometimes people will claim Social Security early. If I lose my job and I'm having trouble getting back into the workforce and I need income, that's a good reason to claim Social Security early. Also, if I have concerns about my longevity, if I'm concerned that I might not live well into my 70s, that can be another good reason to claim Social Security early. But what we want to understand when we claim Social Security early is that we will receive a reduction in our monthly benefits. And that reduction will follow us throughout the rest of our retirement. And that's important because, as we can see, a full 54% of people will typically claim before they hit full retirement age. And as a result, they will receive a smaller benefit. Now, if you look at the right side of the slide, you'll notice that a very small percentage of people, only about 5%, will wait until age 70 to claim Social Security. Now, I know a lot of you are probably looking at that and thinking, why on earth would anybody wait all the way until age 70 to claim Social Security? Well, I'll tell you what, in my experience, the most common reason for people to wait to claim Social Security is. Just like if you claim Social Security early, you get a smaller monthly check. If you delay claiming Social Security until you turn 70, you can maximize the amount of your monthly check, which is great. But for people who are married, this can be a very important strategy because if you are married and you have the higher Social Security benefit between you and your spouse, remember that your benefit will ultimately become your spouse's survivor benefit. And it's kind of funny because sometimes people will be very cavalier in terms of when they're going to claim Social Security. You know, they take kind of an attitude like, you know, what's the difference if I claim early, if I claim later, when I'm gone, I'm gone. It's no big deal, right? Well, you know, that's kind of true, but I will always ask people the question, which is, are you interested in maximizing the survivor benefit that your spouse gets when you're gone? And it's interesting how quickly that can change people's attitudes. And the way that you can do that is to wait until age 70 to claim your benefit, maximize your benefit, and by doing that, you're also maximizing your spouse's survivor benefit. So that's a big reason why some people will decide to hang in there and wait until age 70. We're going to come back to survivor benefits in a little bit. Now, like Frank said, I too am very much looking forward to be able to get back out into the field and do this presentation face to face. You know, I didn't mention it, but what we'll do here today is we'll hold questions and answers until the end, which is kind of what you have to do with this format. I miss getting live questions, and one of the questions that would come up a lot when we do this presentation is, you know, people are a little bit skeptical, and they would say, well, you know, you're telling me I should wait until full retirement age, or I should wait until age 70 to claim. Are we really talking about that much money? Does it really make that much of a difference if I delay claiming my benefit? And the answer is, you know what, it can. And so what I want to do here is walk you very quickly through an example to show you how much additional Social Security income you can receive if you hold off on claiming your benefit. So here we have Jim and Linda, married couple. It's a very common scenario. Jim is 66, Linda is 61, and they both work and they're both eligible for their own Social Security benefit. So at Jim's full retirement age, he would just get just over $2,500 a month. And at Linda's full retirement age, she would get not quite $1,700 a month. So to put everything in perspective, let's take a look at what would happen if Jim and Linda claimed as early as possible. Because Jim could claim tomorrow. He's 66 years old. Linda would have to wait until she turns 62, but we'll assume she goes ahead and claims at age 62. If they did that over the course of their retirement, Jim and Linda would receive about $1,387,000 in Social Security benefits, which is really pretty good. Now, a very common question that comes up here is, well, how long a retirement are we talking about here? So what we're using in this example is we're assuming that Jim will live to his statistical life expectancy of about 85 years old, and Linda will live to her statistical life expectancy of about 88 years old. So that's the assumption that we're working on here, that Jim and Linda are both going to live a pretty long time. Now, what if Jim and Linda decided to wait just a few years to claim their Social Security? Now, we recognize most people don't want to wait until age 70 to claim. So we're not going to have them wait all the way until age 70. But what if Jim could just hang in, wait until he's 69, and Linda were to wait until she was 68? If they did that over the course of that same retirement, what we would see is that Jim and Linda would receive an additional $196,000, almost $197,000 in additional Social Security income over that same retirement. So I don't know about you guys, but when I see $197,000, to me, that can make a real difference over the course of your retirement. So that's what we can do if we can delay that Social Security claiming decision. Now, even if you're a single person, the decision to delay your benefit can pay off if you live a long time. So here we have Jim, he's 61, his monthly benefit would be $2,600 a month. His full retirement age is 66 years and 6 months. We're going to talk about why that is a little later in the presentation. But very simply, if Jim claims at 62, he would receive $699,000 in benefits over his life expectancy, which again, to 85 years old. If he were to wait until his full retirement age, he would receive an additional $133,000 in benefits over that same time frame. And if he were to wait until he turned 70 and he were to live to be 85 years old, he would receive an additional $199,000 in Social Security benefits. So when we talk about delaying when you claim Social Security, we are talking about significant money. Now, again, that doesn't mean it's going to be right in every single case, but we want to be aware of that when we're making our Social Security claiming decision. Now, as we've alluded to, longevity is a very important part of the Social Security claiming decision. And we've been talking about statistical averages, 85 for Jim, 88 for Linda. There's another way to think about longevity, and that's more of a probability type of analysis, and that's what we're looking at on this slide. So what we're showing here very simply is if you're a healthy 65-year-old man, you have a 50-50 chance to live to be 87 years old. You have a 25% chance that you will live to be 93. And for women, the numbers are even more amazing. A 50-50 shot to live to be 89, a 25% chance of living to be 96. And the reason we point this out is that our research at Nationwide shows that many people underestimate their life expectancy when they're making their decision to file for benefits. So we have to consider the fact that we are likely to live a little bit longer than we might think we're going to live. Now, one last point I want to make before we move on as it pertains to longevity has to do with potentially claiming early. And as I mentioned before, yes, there are some advantages to delaying when you claim, but there are some situations in which where claiming early can make sense. And one of those has to do with longevity. And there are a couple of numbers that I want you to think about. if we were to plot out break-even points, so just kind of bear with me here for a second. So let's say we were considering for an individual, like Jim in our prior example, claiming at 62 versus claiming at full retirement age versus claiming at age 70. There are break-even points at which those strategies pay off. And there are two ages I want you to kind of try to remember if you can. The first age is 79. And the reason 79 is important is when we look at break-even points, if I don't live to be 79 years old, then claiming at 62 will provide me with the highest cumulative benefit before I pass away. And it makes sense because I'm starting my benefit earlier. I'm not living as long. So that would be actually the best strategy. Now, the other age I want you to remember, though, is 84. Because 84 is the age at which claiming at age 70 provides the highest cumulative benefit. So as a, kind of a rule of thumb, but if you don't expect to live to be beyond 78, 79 years old, that's when claiming early might make sense. If you are concerned, on the other hand, that you might live to be beyond 84 years old, that's when delaying your benefit to age 70 can really pay off. Now, the calculation's a little bit different when you're married, and we're going to look at that at the very end of the presentation, but that's something that you might want to just keep in the back of your mind when you're trying to figure out what's going to be the right decision for you. Okay, so now we're going to change gears a little bit, and we're going to look at some of the basic features of Social Security, basically the things that everybody should know about how Social Security works. And we're going to start with 4 things. The first is pretty obvious, it's pretty simple, but it's really important, and that is, for many people, Social Security will be their only source of guaranteed lifetime income in retirement. We know that the pension, as it once existed, has largely faded from the American workplace. The last statistics I saw suggest that fewer than 20% of American workers in the private sector can't expect to receive any type of pension payout when they retire. And that makes Social Security very important. And so that's why we have so many people on the webinar today. We want to make the right decision when it comes to Social Security. Now, another thing about Social Security to keep in mind is that it is indexed to inflation, and this is very important. We will get, once we're on Social Security, and even while we're waiting to claim Social Security, our benefit is being adjusted every single year based on the inflation rate. Now, in some recent years, they've been very small increases because inflation over the last 10 or so years has really been historically low. But on average, we can expect an average Social Security cost of living adjustment of around 2.6%. And that doesn't seem like a lot, but over the course of a long retirement, that's going to make a huge difference. So that's an important feature of Social Security. Here's another one, and this is one that a lot of people aren't aware of, but it's really important. Social Security is a very tax-efficient stream of income in retirement. So, at the federal level, your worst case scenario for Social Security is that you will pay taxes on 85% of your Social Security benefit each year. So if I was receiving $20,000 of Social Security, I would only have to pay taxes on $17,000, and $3,000 of it would be completely tax-free. And that's your worst case scenario. Depending on how much other income you have, you might actually pay taxes on less than 85% of your Social Security, but you'll never pay taxes on more than 85% of your Social Security. Now in California, I know many of you are in California, another important thing to keep in mind there is that Social Security is exempt from California state income taxes. So that's kind of a big deal as well. And so when we can delay claiming Social Security and we can maximize that monthly check and that annual benefit, we are maximizing what is, quite frankly, a pretty tax-efficient stream of income. So that's important. And then finally, there's survivor benefits. And I started to talk about this a little bit before. So what I want to do now very quickly is walk you through a quick example of how survivor benefits work so that you can factor that into your claiming decision. So let's say, I'll just use my wife and I as an example. let's say my wife and I are retired. We both work. We both have our own Social Security benefit. My wife took some time out of the workforce to raise our son, so her benefit's going to be a little bit smaller. So let's say I'm getting $2,500 a month and my wife is getting $1,500 a month. So collectively as a couple, we're getting $4,000 a month. That's pretty good. Now the question is, what would happen if I were to pass away? Well, the good news is that my wife, my $2,500 a month benefit would become my wife's survivor benefit. So she would go from getting $1,500 a month to collecting $2,500 a month. That's the good news. The bad news, however, is remember, as a couple, we were getting $4,000 a month. And now going forward, my wife's going to have to get by on just that $2,500 a month. So what if somebody asked me the question, Doug, would you be interested in maximizing the survivor benefit that your wife would get when you're gone? I might be very interested in that. So how do I do it? Well, what I could do is rather than claim at full retirement age, I could delay claiming until age 70. And if I did that, my monthly check would become significantly higher. It would go from $2,500 a month to close to $3,000 a month. And when I lock in that higher benefit for myself, what am I also doing? I'm locking in a higher survivor benefit for my wife. So now if I pass away, she would get the full $3,000 a month going forward. Now, there's obviously a trade-off involved because, that means 3 or 4 years of me not collecting Social Security. But if my objective is to provide that higher benefit going forward, and if I believe I'm going to live well into my 80s, that trade-off can make sense. So that's something to consider. Okay, so now we're going to get into a little Social Security history. And you may be wondering, who's the woman on this slide? Well, believe it or not, this woman is something of a celebrity in Social Security circles. Her name is Ida Mae Fuller, and she was the very first monthly recipient of a monthly Social Security check. Believe it or not, when Social Security was first being rolled out, they paid you a lump sum benefit when you hit full retirement age. Needless to say, that did not work out particularly well. So in 1940, they went to the monthly check. Now, you can't see it on this slide, but I can tell you that the amount of Ida's monthly Social Security check was $22.40. And the reason I mention that is to draw your attention to the last bullet point on the slide right at the bottom, and to point out that Social Security was never intended to be our sole source of retirement income. And that is really important to understand because for most people, Social Security is not going to be enough to cover your essential monthly expenses in retirement. Now, I'm getting to the point where I spend a fair amount of time thinking about my own retirement. And I'm sure many of you do as well. And here's a little suggestion I have in terms of preparing for retirement. Think about if you retired tomorrow, what would your expenses be like next month? Right? You're going to have a lot of expenses that are not going to go away when you retire. For example, the number one monthly expense that most people have in retirement is housing, right? The days of paying off the mortgage before we retire are kind of behind us. I know I'm not going to be doing that, and I don't think a lot of people really get to do that anymore. So we're going to have a mortgage, or we might have rent. But for most people, that's going to be their number one expense. Number two biggest monthly expense in retirement on average, healthcare. Even after you sign up for Medicare, you're going to have premiums for Medicare. You're going to need supplemental insurance to go along with your Medicare. You're probably going to have significant out-of-pocket expenses even after you're on Medicare. That's going to be a cost as well. But anyway, my point is, start thinking about those expenses you're going to have every single month, even after you retire, and figure out what that number is. Then compare that number to your monthly Social Security check. What most people will find is it's not going to be enough. And ultimately, that's why we work with a financial professional. That's why we work with Frank and his team, so that they can help us make sure that we're saving enough and we've got strategies in place to supplement our Social Security so that we can comfortably cover all of those expenses that we're going to have even after we retire. Okay, so now we're getting into the fun part. This is what everybody wants to know. How much am I going to get? So in order to answer that question, there's a couple of important concepts that we want to be familiar with. The first is your primary insurance amount, and the second is your full retirement age. So we're going to start with your primary insurance amount. Very simply, your primary insurance amount is the amount of your monthly check at full retirement age. So how do you know what that's going to be, or how does Social Security calculate what your primary insurance amount is going to be? Well, what Social Security does is they calculate something called your average indexed monthly earnings. And they do that using your 35 best years of earnings. So what they do is they take those years of earnings, they index them for inflation, so they adjust them going backwards, and then they average them out, and that's what they use to calculate your primary insurance amount. Now, as you can see on the bottom of the slide, there is a maximum primary insurance amount. So if you are achieving full retirement age in 2021, your maximum primary insurance amount would be $3,148. So you could be Jeff Bezos, but if you're hitting full retirement age this year, that's going to be your check, $3,148 per month. Now, that is not to say, however, that that's what everybody gets. In fact, the average person on Social Security actually gets closer to about $1,600 a month. So the question is, why so much lower? Well, in order to qualify for that maximum primary insurance amount, you have to have a pretty robust earnings history. You have to average close to $140,000 a year, indexed for inflation going backwards, for a pretty significant portion of that 35 years to get up to that maximum benefit. So not everybody actually qualifies for that benefit. But the other reason people typically take less is something that we've already discussed. People tend to claim early, and when we claim early, our check is reduced. So that's a factor as well. So how do you know what your primary insurance amount is going to be? Well, that's pretty easy to do. And what I would strongly encourage everybody on the webinar to do, not right now, but after we're done, is download a copy of your Social Security statement. You can do that by going to ssa.gov/myaccount. You're going to have to set up a user ID and a password, but once you do that, you can go in and you can download a copy of your statement. And that's a good reason to go in there on its own. But there's one other reason I do want to point out, and that is that for whatever reason, Social Security is a very popular target with identity thieves. If your personal information was ever compromised, there's a pretty good chance that one of the first places the thieves would go would be to Social Security to start sniffing around and see if there was a way they could fraudulently make a claim on your benefit. So when you go to ssa.gov/myaccount, you're basically making it harder for any potential bad guys to get into your account and start messing around and making false claims on your benefit. So that's another good reason to do it. So what are you going to find when you download your statement? Well, there's lots of useful information on your Social Security statement. We're just going to highlight a few things here. The first thing you're going to see on the very front page of your statement is your primary insurance amount. And this is your estimated benefit at full retirement age. So basically what they're going to do is they're going to take your current earnings trajectory, they're going to project that forward, they're going to factor in potential cost of living adjustments, and they're going to estimate what your benefit will look like at full retirement age. Now, it could vary a little bit, particularly if you have a big change in your earnings. And usually the good news is it's more likely to go up than to go down, because if all of a sudden you got that big promotion and now you're making a lot more money than you've made in the past, well, that's going to start driving your benefit up. If you have a disruption in your work history, well, they're going to base it on your current earnings record. So it's less likely to go down for a lot of reasons I'm not going to get into right now, but that'll give you a pretty good idea what your benefit is likely to be. When you open up the statement, you're going to get some additional information that's also very helpful, and that is what you would receive based on claiming at different ages. So here on the slide, you can see at full retirement age, 67, you would get $1,827 a month. But what if you claim at age 70? Your benefit goes up to $2,266 a month. If you were to claim at 62, you would only receive $1,271 a month. And this is important because you can really get a sense of just how big the difference can be claiming at 62 versus claiming at 70. In this example, it's about $1,000 a month. That's a big deal. And so you definitely want to consider that in your claiming decision. Now, the third piece of information that's kind of fun that you will find in your Social Security statement is your complete earnings record. This is all of the Social Security taxable income that you have made since you got your very first job. Mine was in high school, so mine goes all the way back to, I think it was like 1979 or 1980. But there, it's going to be there every single year. So when you look at this, it's kind of funny. I mean, it's kind of fun to look at, but you do want to be checking a couple of things here. The first thing you want to do is just review your earnings and make sure they seem accurate. Now, what you will notice is that in some years, especially if you made a lot of money, your Social Security earnings will be less than your Medicare earnings. And the reason for that is Medicare taxes are assessed on all of your earnings. Social Security taxes stop when you get to a threshold. Currently, that threshold is just under $140,000 a year. So your Medicare earnings actually will give you, will probably jive better with your memory of what you made. So you want to make sure these numbers are accurate. And what I would also suggest is you're looking for zeros here. Now, some people know they're going to have some zeros. Some people would be surprised to see zeros. If that happens, you can fix that. But the reason I say look for zeros, remember, Social Security is going to be basing your benefit on your 35 best years of earnings. And sometimes I get the question, well, what if I don't have 35 years of earnings? What if I only worked for 20 years? Does that mean I'm going to have 15 zeros averaged into my average index monthly earnings? And unfortunately, the answer to that is yes. And so sometimes people will ask, well, you know, I'm thinking about retiring, but I'm thinking I might work a few more years. If I did work a few more years, would it make a difference in my monthly Social Security check? And the answer to that is, well, yeah, if you're replacing zeros in your earnings record with years of earnings, it can, after a few years, really make a difference in your check. So that's something that you want to be checking, but that's your primary insurance amount. That's your statement. Now, the next thing we're going to look at is full retirement age. Now, this is a pretty simple concept. Your full retirement age is based on when you were born. And if you were born in 1954 or earlier, full retirement age is 66. If you were born in 1960 or later, your full retirement age is 67. And if you were born during one of the years in between in the late 1950s, as you can see, your full retirement age goes up by 2 months for each year. So in our example before with Jim, his full retirement age was 66 years and 6 months. And from that, we know he was born in 1957. So it's not always a nice round number. Now, why is it important to know your full retirement age? Well, your full retirement age will impact what happens if you claim early or if you claim later. So as we look at this slide, what we're looking at is, let's assume your full retirement age was 66. And if we look right at the middle of the slide, let's assume that your primary insurance amount or your benefit at full retirement age was $1,000 a month. I can claim as early as age 62, but look what happens if I do. I'm only going to get 75% of my primary insurance amount. So in other words, instead of getting $1,000 a month, I'm only going to get $750 a month. Now, what this slide also shows us, though, is the potential benefits of waiting. Because what we see here is for every year beyond full retirement age that I wait, I'm going to get a full 8% increase in my monthly benefit based on my primary insurance amount. So in other words, it's 8% simple interest. So if I were to wait all the way until age 70, look what happens. I'm now going to get 132% of my benefit, or $1,320 a month. That's a pretty big deal. That's a 32% higher benefit compared to my full retirement age. But here's the real kicker. It's a 76% higher benefit when I compare that to claiming at 62. That's the kind of difference that we're talking about here. Now, if my full retirement age is 67, same concept, but the math just changes a little bit. I can still claim at 62, but now look what happens. I don't get 75% of my benefit. I'm down to 70% of my benefit, or only $700 a month. I can still wait until age 70, but I don't get quite as big a bang for my buck if I do, because now I'm only getting 124% or 1,240. But still, 62 to 70, 77% higher benefit. Full retirement age to 70, only a 24% higher benefit. But still, there are still some advantages, potentially, depending on your situation, to waiting. Okay, so now we're going to look at some of the rules that we should be familiar with, some of the different benefits, actually, I should say, that we want to be familiar with. We're going to look at the spousal benefit. We'll touch again on survivor benefits. We'll talk about divorce. Now, in the interest of time, I'm not going to talk about disability today, and I'm also not going to talk about dependent children. However, I do want to make you aware that if you are 62 years old and you claim your retirement benefit and you have minor children at home under age 17 or younger, those children will also get a benefit of up to 50% of your primary insurance amount. And I mention this because we are starting to see people wait until later in life to have kids. And I have run into people who've had this situation where I'm in my early 60s, I've got young kids at home. And you know what? That can actually change the dynamic in terms of when you should claim Social Security. Because if your kids are young enough and are going to collect for a long enough period of time, that can actually be another reason why you might want to claim at 62 instead of waiting. But that's really all we're going to get into on that for now. It's basically, I just wanted to make you aware of that. And if we get any questions, I can certainly try to answer those. Now, what about the spousal benefit? And I think in order to explain the spousal benefit, I hope you guys can forgive me for this. I'm going to kind of travel back in time a little bit. And the reason, is to understand the spousal benefit, you kind of have to go back to when it was introduced. So think back to 1940 and think what the average married couple looked like back in 1940, right? We all know it's Ozzie and Harriet. We got the husband who goes to work every day. The wife either did not work or only worked a little bit. And so in that scenario, you would have one spouse qualifying for Social Security and another spouse who did not qualify for Social Security on her own. In order to qualify for Social Security, you basically have to work for 10 years. And some women didn't have that work history. And so the spousal benefit was introduced. Now, I'm using husbands and wives because of the historical context. Please note, all of these rules are completely gender neutral. So I'm just like, playing with the history when I describe this. But so to bring it up to current terms, let's say my wife worked and I was a stay-at-home dad and I didn't work at all. I don't qualify for Social Security, or I do, but I qualify for a very small benefit. My wife, on the other hand, is going to get $2,000 a month at full retirement age. Well, when she turns on her benefit, I, as a spouse, could get up to $1,000 a month simply because I'm married to her and she's entitled to a benefit. I can claim as early as age 62, but if I do, I don't get the full 50% of my wife's primary insurance amount. I would get less, around 35%. But as long as I wait until full retirement age to claim, I could get that full 50% of my wife's primary insurance amount, or $1,000 a month. So, it's an important benefit for some people. It's not as important as it used to be, though. Just again, to give you a little bit of historical perspective, back in 1960, about 60% of women only qualified for Social Security because they were married to somebody who qualified for Social Security. Fast forward to 2017, only about 20% of women will end up claiming the spousal benefit. And the reason for that is pretty simple. If you worked and your benefit is more than 50% of your spouse's benefit, you don't need the spousal benefit, because when it's time for you to claim Social Security, you'll just get your own benefit. But it is there, and we do want to be aware of it. And it does come into play in some situations. Now, what I wanted to touch on with survivor benefits is I just wanted to make a really important point. We've talked about how survivor benefits work, but the point I want to make is that survivor benefits are kind of unique under the Social Security rules in that they provide one of the only times where you can start by claiming one benefit and then switch to another benefit later on. So here's what I mean. Let me walk you through another example. Let's say my wife and I, we both worked, we have similar earnings histories, and in fact, we are entitled to the exact same Social Security benefit at full retirement age. I'm going to get $2,000 a month. My wife's going to get $2,000 a month. And let's say we're 60 years old. We're thinking about, we're not retired yet, but we're looking at that, and I pass away. Well, now my wife has kind of an interesting situation because she's eligible for two different benefits. She's entitled to a survivor benefit based on my record, but remember, she's also entitled to her own benefit based on her own record. So here's what she could do. She could make a decision to maximize one of those benefits, but while she's maximizing one of those benefits, she can collect the other benefit. So here's how it might work in my example. So my wife's 60, she's grief-stricken, she cannot return to work. So she decides she's going to take the survivor benefit at age 60. Now that would be my $2,000 a month, but it would be reduced because she's claiming it at age 60. So she would actually get about $1,400 a month, assuming she had a full retirement age of 67. Okay, so now she's 60, she's getting $1,400 a month. Well, she can collect that $1,400 a month all the way until she turns 70. But then what happens when she turns 70? Well, remember, she had her own benefit of $2,000 a month. And by waiting until age 70, what is she doing? She's getting those 8% increases each year that she waits. And so by the time she turns 70, her benefit has now grown to $2,480. And then at that point, she can switch and she can lock in that higher benefit for the rest of her retirement. So that's something to be aware of when you're entitled to two benefits, your own and a spousal benefit. The general strategy that you want to be familiar with is figure out which benefit is potentially higher and then try to maximize that benefit. So that's something to consider as well. And now let's talk about divorce. This is always a lively topic when we used to get to do this presentation in person, and hopefully we will again sometime soon. But the big issue when it comes to divorce is how long were you married? And the magic number is 10 years. If you were married to somebody for 10 years and then you get divorced, you maintain all of your rights against your ex-spouse's record as though you were still married, which means that you can claim a spousal benefit based on your ex's record, or you can claim a survivor benefit when your ex passes away. So, what's the big issue with divorce? Remarriage. This is the big issue. But here's the good news. We don't care if your ex gets remarried. I've had people come up to me over the years and say, I know I'm entitled to a benefit based on my ex, but he or she got remarried and I don't want to mess up their new spouse, or I don't want to make them mad, so I don't know if I'm going to claim based on my ex-spouse's record. Here's what you need to understand. If you make a claim for benefits based on your ex-spouse's record, it does not impact your ex-spouse at all. It doesn't impact your ex. It doesn't impact your ex's new spouse. It has zero impact on them. And that's why you don't need their permission. You don't need their cooperation. All you need is date of birth, social security number, proof that you were married for 10 years. You call Social Security, make an appointment, get on the phone. They will tell you what you are entitled to. And then you can figure out if it makes sense to make a claim based on your ex's record. Now, while we don't care if your ex gets remarried, we do care if you get remarried, because if you get remarried, it's going to impact your ability to claim based on your ex's record. And the first rule is pretty simple. If you get remarried, you can no longer claim a spousal benefit based on your ex. And that makes sense when you think about it, because you have a new spouse now. You can claim based on your new spouse's record. And you might be thinking, yeah, well, my ex made more money and they have a better benefit. Well, unfortunately, I can't help you with that. But at least you have a new spouse now, you can claim on your new spouse for a spousal benefit. Now, for survivor benefits, it's a little trickier, because with survivor benefits, we don't just care whether you get remarried. We care when you get remarried. So here's the rule. If you get remarried before you turn 60, you can no longer collect a survivor benefit when your ex passes away. But if you get remarried at age 60 or later, and then your ex passes away, guess what? You can collect a survivor benefit based on your ex, even though you're now married to somebody else. So you probably didn't think when you got on this webinar today, you were going to get marriage advice. But if you're looking at a second marriage scenario and you're close to your 60th birthday, you might just want to push that wedding date right beyond your 60th birthday. That way, if something awful happens to your ex, you can collect the survivor benefit, even though you're remarried. Now, here's one last question that comes up a lot with divorce. I was married for 10 years, got divorced, got married again. That marriage didn't last very long. Death, divorce, doesn't really matter why. The question is, can I still claim based on my first ex, even though I've had a subsequent marriage? And the answer to that is, as long as you're unmarried, yes, you can still claim based on that first ex, as long as you are no longer married from that second marriage. So keep that in mind as well. Okay. So one issue that comes up from time to time, or a very common question, is I'm thinking about claiming Social Security, but I'm still working. Does that make sense? And I don't like to give make really general statements, but I'm going to make an exception here, and that is it might not make sense. And here's why. It really depends on how old you are. If you are not at full retirement age yet, you're probably going to want to wait until you're at full retirement age. And here's why. Because before you hit full retirement age, if you're claiming Social Security and you also have income from work, Social Security is going to withhold some of your benefit based on your earnings from work. So if you look at the left side of the slide at the bottom, you'll see there's a threshold. It's almost $19,000. And for every $2 you make over that threshold, Social Security holds back $1 of your benefit. So if you made $49,000, which is $30,000 above the threshold, Social Security is going to hold back $15,000 of your benefit. Now, the withholding in and of itself isn't that big of a deal, because once you hit full retirement age, not only does the withholding stop, but they take all the money they withheld and they build it back into your benefit going forward. So you'll get that money back over the course of your retirement. The bigger issue in my experience is it's very confusing when Social Security starts holding back your benefit. You get letters, one day, 1 month you get this check, then all of a sudden the amount of your check is changing and you're getting letters from Social Security. And if your income fluctuates from year to year, the withholding is going to change every year. It can be a mess. So I would say, look, if you're still working, you have income, hold off at least until full retirement age, because at full retirement age, there's no more withholding. You can work, you can collect your full Social Security benefit, no problem. But even then, I might be inclined to say, well, you could get that nice 8% increase if you hold off until either A, you retire, or B, you turn 70. But that's based on, personal circumstances. So, but you want to be aware of that, if you work prior to full retirement age and you're collecting Social Security, that withholding issue can be a little bit of a nightmare. Okay, so now what we're going to do, we're getting to the home stretch here. I want to share with you our Social Security 360 Analyzer. This is a fantastic tool that is available to you through Frank and then the team at Connecta. And what it basically is a Social Security calculator. And when you provide us with some basic information, and we'll talk about that in a few minutes, we can prepare a report for you. And what this report is going to do, first and foremost, is it's going to show you step by step how you can maximize your Social Security benefit based on your life expectancy. You can use your statistical life expectancy. You can tell us what life expectancy you want us to use. Whatever you want to do, we can do that with the report. And what I like about the report is the first thing it's going to do is it's going to show you how to maximize your benefit. Now, here's the issue with that. We talked before about that break-even point at age 84, right? If I live to be 84, waiting to claim until age 70 is going to provide me with the highest cumulative benefit. in most instances. Well, what's my life expectancy? It's 85. So in many cases, the report's going to tell me, well, the way that you maximize your Social Security benefit is you wait until age 70. So when we're comparing strategies, that might be this black line on the left, right? This is my cumulative lifetime benefit if I wait until age 70 to claim. But what I like about the report is we can look at some alternatives. And if you're like me, I mean, I'm already bummed out that I have to wait until 67 to get my full Social Security benefit. So I might want to say, well, you know, just to compare, show me what my cumulative benefit would look like if I claim at full retirement age. And that might be this orange line just to the right of that black line. And if you're like me, you might look at this orange line and say, you know what? That's close enough for me. I'm going to claim at full retirement age. Again, no right or wrong answers. I'm just making an informed decision. I realize I'm leaving a little bit of money on the table if I live a long time, but I'm okay with that because I'd rather see those checks coming in right at full retirement age, take a little pressure off my retirement savings. If that's what I want to do, that's what I can do. But again, we're just showing the different options here. Now, another thing we can show you is a break-even analysis, and this is a little bit more complicated because here we're showing you a break-even for a married couple. So when we're comparing different strategies, like the gray strategy, the blue strategy, the orange strategy, what we can do is we can say, okay, well, if Mrs. Doug lives to be 90 and Doug lives to be 85, well, this gray strategy seems like it would be the best, but, or actually that would be the blue strategy. But if we were to both, you know, pass away much earlier in our early 80s, late 70s, early 80s, well, then this gray strategy is better. So what it allows you to do is evaluate strategies based on contingencies, how long you think you might live. But I would argue this is the most important slide because this takes us back to item A Fuller. And remember with item A Fuller, the question was, is Social Security going to be enough to meet your essential monthly expenses? Well, this is what this chart shows. This thin gray line that runs along the top here, that's your desired annual income. That's the money you need to pay the bills and hopefully have a little left over to have some fun. These dark blue bars on the bottom, this is your Social Security. And what you can see very clearly in this graph is there's a gap here. And what you can do when you're working with Frank and his team is you can figure out what do I need to do to solve for this gap so I have enough income coming in. So very easy to get a copy of the report. All you have to do is ask for a copy of the 360 Analyzer Fact Finder. It'll probably take you all of 10 minutes to fill it out, if that. The toughest thing about filling out this Fact Finder is you have to have your Social Security numbers. You need to know your primary insurance amount. You need to know your spouse's primary insurance amount. Other than that, it's just dates of birth and when you're going to retire, and it's pretty straightforward. So hopefully today what we've done is we've helped you get a good understanding of the basics of Social Security. My suggestion would be, if you're interested in starting to plan this stuff out, get a copy of the 360 Fact Finder, fill it out, get a copy of your report, make an appointment, sit down, and start working on your retirement income plan. And so with that, Frank, I'm going to turn it back over to you so you can let everybody know how to contact your team, and then we can try to tackle questions for a few minutes afterwards. So
sounds good, Doug. Absolutely incredible information. You know, every time I always think I've been doing this for a while now. I know it, and then I hear it, and I'm like, oh my gosh, you're right. And I learn something new every single time. Absolutely incredible. Thank you so much for the information. You know, as Doug talked about, is the complementary assessment. You know, you really can't figure out Social Security without doing that assessment. So here we have the next two slides for you, featuring our Connect to Wealth Management financial advisors. Please find the area closest to you. Take time to go to connecttowealth.org, schedule an appointment, visit with our Connect to Wealth financial advisors. They have the ability to get this assessment, go over the assessment with you, take those Social Security numbers, make them part of that financial plan. Doug, has said it a few times, with item A, right? Item A, that Social Security isn't your retirement. it's a portion of it. How you plan is having that financial plan. Meet with our Connect the Financial Advisors, put those financial plans together, include that Social Security statement, include that Social Security assessment, and let's make sure that we know the best age, the best time, how much is it enough? And then we could plan accordingly. So let's get to some questions. We have a lot. We're going to try to get through all of the questions. I do want to be respectful of everyone's time. So any questions that we are not able to get to, we do have those questions written down, and we will do our very best to have, our financial advisors working alongside Nationwide, get back to all of you that ask questions that are there. So Doug, we're just going to get right into it. If you do have questions, feel free to put them in the chat. You can also put them in the Q&A. I know a lot of people are asking for recording. If you would like a recording, again, go to connectthewealth.org, request a recording of this, and we will get it out to you. So our first question, Doug, is this for you? I'm going to let you handle the majority of all the questions. I'll answer the really easy ones. Is there a cap for Social Security? And I know some of these we went over, but it's always good to hear it again. What I mean is no matter what it does, no matter the income one has paid, is there, and I think, we saw it, but is there a cap for the maximum payout?
Yeah, there is. So remember, Social Security is an earned benefit. The benefit that we receive is based on how much we pay in. And Social Security taxes are capped at just under $140,000, and that is indexed for inflation every year. And so if you've ever been fortunate enough to make more than $140,000, what you've noticed is once you get to that point, they stop collecting Social Security taxes. And because of that, there's also a cap on how much you can get. So when we looked at that maximum primary insurance amount of $3,148, that's why there's a cap, because those two numbers work. They only collect a certain amount of taxes every year, and that's because your benefit is capped at that $3,148. Now, remember, if you waited beyond your full retirement age, you could get more than $3,148 monthly, but at full retirement age, yes, it is capped. And as a result, the amount of income that you pay Social Security taxes on is also capped. Now, that's kind of a political hot potato in Washington right now. There's a lot of people who think that we should maybe be assessing Social Security taxes on more income, but we'll have to see how that all unfolds. But right now, that's how it works.
All right, next question, two-parter here, I believe. You start Social Security at 66, full retirement age for this person.
Yep.
Then at 70, you repay one-time forgiveness from Social Security. What percentage more of a benefit would you receive at 70, and is that beneficial?
Okay.
So we'll start there.
Okay, so couple of things here. The first part of that question has to do with, what if I claim Social Security early, or what if I claim Social Security and I realize, I really wish I hadn't done that for whatever reason? There are two things to be familiar with. The first is there is an opportunity you can, on a one-time basis, you can essentially withdraw your application for Social Security. So if I was not yet full retirement age, so let's say I claimed at 62, realize, I'm going to be able to get another job, I wish I hadn't claimed. If I catch that within the first year, what I can do is I can pay back all of the benefits that I've received and basically withdraw my application, and they treat it as though I never applied. And then I can go ahead and apply whenever I want to. I think the question asks, well, what if I'm 66 and I decide I really should have waited until age 70? Well, once you hit full retirement age, then you can suspend your benefit. So if I was at full retirement age and I was getting, let's just say, $2,600 a month, and I decided, you know what, I don't need this money right now. I'd rather get a higher benefit, or I'd rather maximize my spouse's survivor benefit. Because I'm full retirement age, I can suspend my benefit. I can just call Social Security and say, that's it. I'm suspending my benefit. And then I will start to get those 8% delayed retirement credits every year. So if my full retirement age was 67, let's say it was 67, I could get that additional 24% when I turn my benefit back on at age 70. So prior to full retirement age, I have to withdraw my app and pay everything back. At full retirement age, I can suspend my benefit and then restart it later on, get those delayed retirement credits. However, very important point, if I suspend my own benefit, anybody who is drawing a benefit from my record, which most commonly would be my spouse, if my spouse was taking a spousal benefit, then that benefit would also stop. So that's really important to keep in mind. When you suspend your own benefit, you're suspending all benefits that are based on your record, including a spousal benefit. So it's a kind of a complicated analysis that you'd want to go through before you did that. But I hope that answered the question. The short answer is, yeah, you can do that.
All right. Great information. If you start collecting Social Security, you go back work full time, obviously you're paying back into Social Security. Does that get added to your benefit?
Yes, so that can happen. So you can start your Social Security benefit. You go back to work. Now, again, if we go back to work before full retirement age, we're going to have to deal with that whole withholding issue. But if I go back to work after full retirement age, there is no withholding, and I'm paying Social Security taxes. So it is possible that I could see my Social Security benefit go up, even though I'm already collecting it, because I've got additional earnings. So the bottom line is, yes, if you go back to work and you're getting Social Security, you're still going to pay your Social Security taxes in, and those can impact your benefit. I don't know how big a change it would end up being, but in theory, yes, those additional Social Security taxes that you're going to pay at that point can increase your benefit.
Fantastic. Does the 2.6 cost of living adjustment make a huge difference over the retirement period?
Well, it certainly can. So let's talk about that really quickly. Now, the 2.6%, it is not a fixed number. So your annual cost of living adjustment for Social Security is directly tied to the rate of inflation in the general economy. And there are many ways economists measure that. There's one particular one that Social Security uses, and it goes up by an average of 2.6%. And when you think about it over the course of a full retirement, again, 2.6% doesn't sound like very much, but remember, 2.6% over 10 years is 26% higher. Over 20 years, it's 52% higher. So over the course of a long retirement, those incremental little cost of living adjustments are very important. And that's why Social Security is such an important benefit, because I always, my mom got a pension from a bank that she worked at when she retired 20 years ago. Her pension is not indexed for inflation. So the check she gets today is the same check she was getting 20 years ago. And believe me, I hear about it. It doesn't go as far as it used to. But with Social Security, you do get a good benefit. And 2.6% doesn't sound like a lot, but over a long retirement, it's going to make a big difference.
Yeah, exactly. And when you think about 2.6% in today's world and what you get in those banks, and those, compared to 1%, it's 1.5 times. So
if you had a bank paying 2.6%, yeah, they'd be knocking down the doors.
Exactly. Having been in this industry a while, I never thought I'd be saying how great 2.6% is, but
yeah,
times have changed. Continuing on, again, we want to be cognizant of time. There's still a lot of questions to go here. Is the survivor benefit always the higher monthly benefit?
So yeah, the survivor benefit, it is. So I think what we're getting at here is, okay, so we talked about if I'm at $2,500 a month and my wife's at $1,500 a month and I die, my wife gets $2,500 a month going forward. That's her survivor benefit. But what if it was the other way around? What if I'm getting $2,500 a month, my wife's getting $1,500 a month, and my wife were to pass away? Well, in that case, I just keep getting my own $2,500 a month. So technically, I'm not getting a survivor benefit because my wife's benefit was not higher than my benefit. I would just keep getting my benefit going forward. So that's typically how that works.
Perfect. Just some fantastic questions here. Will my Social Security check be adjusted if I am receiving a military retirement check also?
Ooh. Okay, it really depends on, so if you are getting a pension in the public sector, and I'm just gonna lump a military pension into that, and I'm not an expert on military pension, so I don't know if there are specific rules to a military pension that I might not be familiar with, but what I can tell you is if you are a public sector employee and you receive a pension where you did not pay into Social Security, that's really the key, is did you pay into Social Security? If you were a public employee in any branch of the government, if you've been paying into Social Security the whole time, and many public employees do pay into Social Security, you will not experience a reduction in your Social Security benefit because of any sort of pension that you get. However, there are certain categories of public employees who do not pay into Social Security. And the most common examples are police officers, firefighters, and in California, teachers. And if you receive a pension where you did not pay into Social Security, then what can happen is if you do claim Social Security, either if you have your own Social Security benefit from, say, a second job or a prior job, you're going to have to deal with something called the windfall elimination provision. And without getting into a lot of gory details, the windfall elimination provision can knock up to $480 a month off of your Social Security check. And that's when you're getting a public pension where you did not pay into Social Security. If I'm trying to collect a spousal or a survivor benefit from my spouse and their Social Security record, but I'm collecting a public pension where I did not pay into Social Security, then I have to deal with a rule called the government pension offset that says my spousal benefit or my survivor benefit would be reduced by 2/3 of my pension. So these are kind of tricky rules. I don't know for sure if those would come into play with a military pension, but really the ultimate issue, I believe, is did you pay into Social Security? If you paid into Social Security, you're probably not going to deal with a reduction. If you did not pay into Social Security, then yes, your Social Security check could be reduced because of a public pension.
Great information. Thank you, Doug. One question that was asked was, you mentioned you weren't going over the disability portion of this today.
Yeah.
They want to know when we'll be doing that. I recommend that you visit connectthewealth.org. We do a variety of really informative webinars like today's on Social Security, estate, trust and estate planning, financial planning, long-term care, and disability. And I'm sure we're going to come back just based on all the great questions we're getting.
And Frank,
the amount of people.
Yeah, Frank, since we did get the question, let me just give you a really quick synopsis of disability coverage under Social Security. In order to make a Social Security disability claim, first of all, you have to have an earned benefit. So you have to qualify for Social Security, which again means working for at least 10 years where you made more than $6,000 each year. The way I think about Social Security disability is, and this is not SSI, which is supplemental security income. That's for people who have very limited resources. This would be for somebody who gets injured on the job, for example. Basically, the way that works is when you make a disability claim on Social Security, it's almost like getting an advance on your primary insurance amount. So if my primary insurance amount was $2,000 a month and I was 55 years old and I became disabled, I would start getting my $2,000 a month as a disability benefit. And I would receive that until I hit my full retirement age, at which point it would transition to a retirement benefit. So now remember, the one thing with Social Security disability is it's a pretty high bar. So if you're trying to qualify for Social Security disability, the standard is unable to engage in any gainful employment. So you really have to be disabled in order to qualify for Social Security. But that's just a really quick overview.
Thank you, Doug. And again, visit connecttowealth.org for a list of all of our, our most immediate webinars, and check back often, as we do have 1 to 2 webinars each and every month. All right, this is a question that I'm glad somebody brought up. I was actually thinking about it. How do we figure in that Social Security may only pay 76% of scheduled benefits starting in 2034 if no changes are made to Social Security?
That is a really good question. So just to give a little bit of background for those of you who may not be familiar with this, every year the Social Security Board of Trustees issues a report on the financial health of Social Security. And one thing that grabs a lot of headlines is the fact that currently, the most recent estimate I saw was that the Social Security Trust Fund, in quotes, which is this big hypothetical pool of money that's been accumulating for the last 70-something years, is scheduled to go to zero in the year 2034. And at that point, Social Security would only have enough incoming tax revenues to pay about 80 cents on the dollar going forward. And sometimes I do talk about this because sometimes people will claim Social Security early thinking, oh, I better claim it early because they're going to run out of money and I'm going to lose out. Couple of thoughts on this. First of all, there are a lot of things that Congress can do to improve the long-term solvency of Social Security. So for example, they could change how cost of living adjustments are calculated. That's come up recently. They could change the full retirement age. So for our kids, right, they could be looking at a full retirement age of 70. They could change the tax rate on Social Security. Currently, it's 12.4%, but it's split evenly between employee and employer. So if they were to jack that up by a full percentage point, it would be split between the employee and employer. Wouldn't seem too bad. Or another one that we talked about earlier is a lot of politicians are saying, well, we should tax more income for Social Security purposes. At some point prior to 2034, Congress is going to get around to dealing with this. Social Security is an incredibly popular program. And, I think most politicians realize what would happen to their political careers if we all had to start taking 20 cents on the dollar, 80 cents on the dollar in 2034. So this is just my personal opinion. And that is that eventually Congress is going to get around to addressing this. And it's very unlikely, in my view, that we're all going to have to take a haircut in 2034. And here's one thing to keep an eye on. With the coronavirus pandemic, Social Security tax revenues were down pretty dramatically last year. And as a result, you're going to see a lot of stories because that number that we just talked about, that 2034 number, that could come down to 2033 or 2032. And I actually think that might be a blessing in disguise because that would really spur Congress to have to deal with this. And because right now they're just going to keep kicking the can down the road as long as they can, but eventually they're going to have to fix it. So again, that's my take. I think eventually, because back in the 70s, there was a similar type of situation going on with Social Security. And that's when they introduced the tax on Social Security. Social Security used to be a completely tax-free benefit. Now we pay taxes on up to 85% of it. So there's stuff that Congress can do to fix it. And I think eventually they will. And here's the last thing I'll mention with my long-winded response. Remember that if Congress does make changes to Social Security, it is very unlikely that they would make changes to people who are already receiving Social Security benefits. What is much more likely is they would adjust benefits for people who are not yet eligible for Social Security. They would basically grandfather people in. For all of those reasons, I think we can be somewhat confident. I don't want to say totally confident, but somewhat confident that once we're on Social Security, it's very unlikely that we would see a hit to our benefits going forward.
Thanks, Doug. Well, we're going to take one last question because I know we're already over time and we want to be mindful of, everybody's days are important. We're seeing some drop off in our attendance. So I want to get one last question because it kind of goes right along the lines of what you said and, what 2020 was. And so it's a great question. Does unemployment compensation count as years contributing to the 35-year calculations? I have been furloughed for 2020 and early 2021, and I'm having trouble finding employment and are collecting unemployment.
Yeah, I'm okay. I'm gonna couch my response by saying I have a high level of confidence in my answer, but I'm not 100% certain. I do not believe that Social Security taxes are withheld from unemployment checks. In fact, now that I think about it, I'm pretty sure they're not. And so if, where you're receiving unemployment, you're not paying into Social Security. And so, yes, that is going to show up in your earnings history. You're going to have that year where your Social Security earnings are going to be lower because when you're on unemployment, they're not collecting Social Security taxes from your unemployment. I'm 99% sure of that, but I would encourage everybody, just Google it, double check it, make sure I'm right. So yeah, unfortunately, that could have an impact on your benefit, but hopefully when we think about our 35 best years of earnings, hopefully that won't be much more than just a blip, and it shouldn't hopefully have a major impact on your Social Security benefit.
Perfect. Thank you, Doug. So once again, for the sake of time, we're going to stop the Q&A at this point. We do have all of the questions, or in the process still of writing down all of the questions, and we will have our Connecta Wealth Management Financial Advisors reach out to you to, number one, set up an appointment, get this assessment started, talk to you about all of the benefits of working with Connecta Wealth Management and answer those questions that you have. Doug, thank you and Nationwide so much for presenting this incredible information. Like I said, I learn something every single time, especially now in times of uncertainty. It's always really important to have a plan. And this is the first step in getting that plan. Working with us here at Connecta is the next. Once again, visit connecta.org for all of our credit union webinars. We do credit union webinars, once again, at least once a month. Connectawealth.org to look at all of our Connecta Wealth webinars, which we do 1 to 2 per month. I thank you so much, everyone, for your time. Hopefully you learned as much today that I learned, and I look forward to being able to answer everyone's questions. Doug, once again, thank you. Stay safe. Have a great evening, everybody. Bye.
Thank you, Frank. Really appreciate the opportunity. Thank you.
Thanks, Doug. Bye.